Welcome to Bayanat, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem. Today, we're doing a deep dive into Keeper. They're really shaking things up in Dubai's rental market using fintech. And the story really revolves around the co-founder and CEO, Omar Abu Inab. Now, this isn't just, another property platform. It's about a very seasoned finance guy pivoting into tech to tackle, well, a massive market opportunity. Omar's background is pretty unique for a tech founder, wouldn't you say? I mean, 18 years in investment banking,
Oh, absolutely.
Wall Street experience, Citi, Credit Suisse, Goldman Sachs, even Guggenheim Partners here in Dubai. What parts of that deep finance experience do you think really helped him spot this inefficiency in the real estate market?
Well, what's really fascinating, I think, is that Keeper wasn't born from like a personal frustration that you often hear about with startups. Instead, Omar and his co-founder, Walid Shihabi, they really leveraged their deep knowledge of investment banking, structured finance, to
Yeah.
basically reimagine how real estate transactions could work. So it's less prop tech solving a user problem initially,
Okay.
and more fintech optimizing a financial process.
Right, approaching it from that financial optimization angle first.
Exactly. Identifying this big inefficiency that maybe someone just focused on, say, the tenant experience might have missed initially.
So, okay, with that finance first strategy, how did they actually start building the platform? Did they jump straight into the rent payment thing?
No, they actually started by focusing on landlords first, understanding what they needed. Things like better insights, transparency, just more efficiency. So think free property listings initially, tools for income statements, document libraries, even a dedicated relationship manager.
Okay, building that trust and value with the property owners.
Precisely. And the real standout feature early on for landlords was Dubai's first live valuation tool, sort of like Zillow's Zestimate in the US. It updates property values based on actual comparable transactions in real time. That was a big deal for transparency.
That makes a lot of sense. So it sounds like they were building this end-to-end thing for the whole property life cycle for investors.
Yeah, exactly. From acquisition, helping with mortgages, then handovers, leasing, maintenance, renewals,
Yeah.
all the way to eventually selling the property if the investor wants to exit.
So streamlining what used to be, well, a really fragmented process, right?
Yeah.
Lots of different people involved.
Totally. Removing headaches, reducing friction points, and you can see it's worked. They're now managing, what, over 6,600 properties?
Wow.
Yeah, with a total asset value north of 4 billion US dollars.
Okay, 4 billion. That's serious scale. It clearly shows they found a real need. But let's get to the really transformative part. That core problem in Dubai's rental market, the checks theft.
Right. It's kind of surprising, isn't it? Such a modern city, but still so reliant on these, well, fairly old-fashioned post-dated checks. Right. Usually just one, two, maybe four payments a year.
Zero flexibility for tenants.
None at all. Which feels very out of step with, how people manage finances today. And that's where Keeper's big innovation comes in. Rent now, pay later, RMPL. It's genuinely the first and only product like it here in the UAE.
Okay, so break down RNPL for us. How does it actually work for the tenant and then for the landlord?
Okay, so for tenants, it's all about flexibility and cash flow.
Yeah.
Let's say your rent is 100,000 dirhams a year, traditionally paid in, say, 4 checks. With Keeper, you could instead pay maybe 106,000 dirhams, so there's a premium. About 6% in this example, but you paid it in 12 monthly installments
Okay.
using your credit card. So no huge upfront payment, easier budgeting. Plus, you can potentially earn miles or rewards on your card.
Right. That makes immediate sense for the tenant side. But what about the landlords? How do they make it attractive for them? They're bridging that gap, right?
Exactly. Landlords get really good options. They can stick with the traditional 4 checks if they want, and Keeper just handles the monthly collection from the tenant. Or, and this is the real kicker, for an 8% fee on the annual rent, Keeper fully manages the property, and the landlord gets the entire year's rent paid up front.
The whole year up front.
The whole year. Plus, they get default protection, so Keeper takes on that risk.
Wow. Okay. Upfront cash and de-risking. That's a very compelling offer for a landlord.
It really is. It fundamentally changes their cash flow situation.
But, okay, financing rent like this, especially offering upfront payment, that must carry risk. How does Keeper manage that? What are their risk mitigation strategies?
They've built a pretty sophisticated digital system for this. It uses open banking, digital verification for really quick applicant approval. They verify income by having applicants securely log into their bank accounts, run automated credit score checks,
Yeah.
do full KYC using the UAE ID,
Standard stuff, but crucial.
right, plus affordability assessments. It's all these layers together that create a robust vetting process.
And that explains the low default rate.
It seems so. They're reporting a default rate of just 0.7%, which is remarkably low for this kind of unsecured lending, essentially.
Yeah, that's incredibly low, especially when you hear about the demand. What was it? Over 20,000 applications?
Yeah, 20,000 applications representing something like $330 million in potential rent value.
And that was with almost no marketing.
Pretty much organic demand.
Yeah.
Which, that speaks volumes about product market fit
Absolutely. It shows they hit a major pain point.
for both sides, tenants and landlords.
Now, Omar himself said that getting the financing sorted is make or break for RNPL. For any startup, especially one doing lending, that's the hard part. How did Keeper pull that off?
Yeah, and this is where Omar's investment banking background, I think, really paid off. They didn't just rely on venture equity for this. They secured major institutional backing through a really groundbreaking deal with Franklin Templeton.
Franklin Templeton, the global investment manager.
That's the one. They structured the first ever startup-issued Sharia-compliant bond, a sukuk, in the Middle East.
Sukuk. Okay.
Yeah, basically an Islamic financial certificate. Similar to a bond. It was a U.S. $30 million deal. That gave Keeper the serious financial firepower they needed to actually offer all this rent financing at scale. It really set them apart.
$30 million in debt financing via a sukuk. That's quite something for a startup.
It really is. Very sophisticated financial engineering.
And it makes sense why RNPL, even though it's maybe 20% of revenue now, is their fastest growing product. You said 30% month-on-month growth.
Yeah, the uptake has been phenomenal. And the vision gets even bigger.
How so?
Well, apparently the Dubai Land Department itself has approached Keeper. They're exploring how to potentially digitize rent payments across the entire city using Keeper's model.
The whole city, wow.
Yeah, imagine renting becoming as smooth as, like, signing up for Netflix, using your UAE pass for identity, DocuSign for the lease, automated monthly payments.
That would be transformative.
It really would. It raises interesting questions about the future of digital government services in the region, doesn't it? And obviously fuels Keeper's growth narrative.
No kidding. And their growth has been steady but accelerating. You mentioned building in year 1, 1,000 properties year 2, now over 6,000 in year 3, plus institutional clients. What's behind that speed?
I think it's a combination. A really high caliber team running multiple things at once.
Yeah.
And that clear split between the co-founders helps. Omar focusing on RMPL, finance, fundraising.
Right.
While Waleed handles the product side, commercial operations. That allows them to move fast. Plus, strategic partnerships like the one with FAB Bank, letting FAB credit card holders pay rent via Keeper and get rewards. Smart user acquisition.
And the results show. You mentioned 8x revenue growth year 1, 5x year 2.
And aiming for another 5x this year. Very ambitious, but based on their track record.
Seems possible. So they've clearly nailed product market fit in Dubai. What's the plan for expansion?
Well, the immediate focus is regional. They've got their license for Abu Dhabi, backed by Badia Capital, so RNPL should launch there soon.
Okay.
And then the big one is Saudi Arabia. They're planning an office and scaling up operations there by 2026.
Makes sense. Huge market potential there.
Absolutely. Just the UAE market alone is estimated at, what, $6 billion annually for this kind of service. So plenty of room to grow just regionally.
Omar mentioned, though, that these inefficiencies, the ones Keeper solves, they exist elsewhere, too, even places like New York.
He did. And conceptually, the model could work globally. But
There's always a but.
yeah, the big challenge is the legal and regulatory environment, especially around things like lease agreements and, crucially, eviction rights.
Ah, right.
Dubai's process, while maybe not instant, is relatively quick, 30 to 60 days, to evict for non-payment. You compare that to some places in Europe or the U.S. where tenant protection laws are much stronger, and eviction can take months, even years.
That dramatically increases the risk for RNPL.
Hugely. Keeper takes that risk on their balance sheet now, and it works because defaults are low at 0.7%. But Omar acknowledged that if they went to the U.S., for example, they'd almost certainly need to partner with an insurance company to underwrite that increased risk.
So focus on the region first, nail that, then think bigger.
Seems to be the strategy. Deepen the penetration here first.
Okay, let's circle back to funding. They just raised US $4 million in equity in May 2024, led by Eco Capital and MEVP.
Right, alongside that $30 million debt facility from Franklin Templeton.
And Omar's financing structure, that 80-20 split, 80% debt, 20% equity, that's unusual for a startup, isn't it? Can you unpack that?
It's definitely not typical venture funding, but it's quite brilliant for this kind of business. Basically, the 80% debt from lenders like Franklin Templeton provides the bulk of the capital needed to fund the upfront rent payments. The 20% equity acts as a buffer, or sort of first loss piece. It means keepers' own equity would absorb defaults up to a 20% level before the debt holders lose anything.
Ah, okay. So it massively de-risks it for the debt providers.
Exactly. And given their actual default rate is way down at 0.7%, that 20% equity cushion looks incredibly safe to lenders. It lets keeper leverage debt to scale the capital-intensive RMPL product without giving away huge chunks of equity, which founders obviously love.
Very smart. Financial engineering meets startup growth.
Precisely. And it positions them well for their next round. They're apparently looking to raise another $10 million with big goals, hitting unicorn status and reaching break-even, they hope, by the first half of 2026.
Ambitious. So wrapping up, what are the key takeaways or lessons Omar shared for other founders, especially in this region?
He emphasized a few things. One was tackling really big problems, not just niche ones, focusing on things that can scale and have long-term impact. Another was continuous fundraising, basically. As soon as you close one round, you should already be thinking about and preparing for the next one to keep momentum.
Always be raising.
Pretty much. And finally, adaptability. Being nimble, being smart, and being willing to pivot or adjust as you learn from the market.
Sound advice. So thinking about Keeper's journey, what's the final provocative thought you'd leave our listeners with?
I think it's about how they use that deep, almost traditional financial expertise, structured finance, risk management, to tackle what seems like a simple payment problem, but one that's globally inefficient.
Yeah.
It makes you wonder, doesn't it? How many other long-standing, maybe unsexy, inefficient processes out there could be completely revolutionized by applying that kind of rigorous financial thinking combined with modern tech? Where else could this blend unlock massive value?
That's a great question to ponder. Food for thought indeed. For more stories like this, subscribe to Bionaut's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.